Let me start with something that's probably been bothering you more than you want to admit. You did everything right. You bought gold. You positioned yourself for uncertainty. You followed the global situation closely. You saw tensions rising, conflicts escalating, and you thought, this is exactly what gold is for: a safe haven, a shield, a protection against chaos. And yet, instead of seeing gains, your portfolio is bleeding. Your gold is down. Your silver is down even more. Double digits. In some cases, nearly half its value wiped out from recent highs. And all of this is happening while the world looks more unstable than ever. Wars are unfolding. Oil supply is being disrupted. Central banks are buying gold at historic levels. Debt is exploding past numbers that once seemed impossible. So the real question is not what is happening, but do you actually understand why it's happening? Because if you don't understand the real mechanism behind this, not the headlines, not the surface explanations, but the actual system that drives these moves, then you are at serious risk of making the worst possible decision at the worst possible time. And that decision could cost you what might be the most important opportunity in the next 5 years. What I'm about to walk you through isn't guesswork. It's not speculation. It's a pattern that has repeated itself consistently for over 5 decades. Every major geopolitical oil shock since the 1970s has followed this exact sequence, no exceptions. And once you truly see how it works, you won't be able to ignore it ever again. More importantly, once you understand what typically comes next, the part almost no one is talking about right now, you'll realize why this moment is far bigger than it appears. So let's break this down properly, starting with the one question most people never get a clear answer to. Why does gold fall during a war? It sounds completely backwards. Gold is supposed to be the ultimate safety asset, the thing investors run to when everything else is uncertain. So why, when tensions escalate and conflict spreads, does gold sometimes drop instead of rise? Take the recent example. When Iran shut down the Strait of Hormuz and conflict intensified across the Middle East, gold didn't surge the way most expected. Instead, it dropped sharply. And this isn't random. It's not market confusion. It's a chain reaction, a mechanical sequence that plays out step by step. It starts with oil. A geopolitical shock disrupts supply, and oil prices surge rapidly. That sudden spike doesn't just affect energy markets, it immediately changes expectations across the entire financial system. Traders begin to anticipate higher inflation, even before it actually shows up in data. And in markets, expectations often matter just as much as reality. When investors believe inflation is coming, they react instantly. That expectation alone shifts pricing, positioning, and strategy across global markets. Now here's where it gets critical. Rising inflation expectations limit what central banks can do. Specifically, they reduce the likelihood of interest rate cuts. Before the shock, there may have been room for easing policy, but once inflation expectations rise, that option disappears. The Federal Reserve, or any central bank in this position, cannot afford to lower rates while inflation pressure is building. So instead of easing, rates stay high or even move higher. And when rates stay elevated, something else happens. Government bonds begin to look very attractive. If you can earn a solid return from a US Treasury with essentially no risk, no storage cost, and no volatility, that becomes a serious competitor to gold. Because gold doesn't pay yield, it just sits there. So institutional investors, large funds managing massive amounts of capital, start reallocating. Not all of them, but enough to create pressure. Some capital flows out of gold and into bonds. At the same time, there's another force at work. Global investors, seeking safety, rush into US dollar-based assets. This increases demand for the dollar itself, strengthening it. And since gold is priced in dollars, a stronger dollar naturally pushes gold prices down. It's not about gold becoming less valuable, it's about the currency used to price it becoming stronger. So now you have 3 forces hitting gold at the same time. Higher interest rates increasing the opportunity cost of holding it. capital rotating into bonds, and a stronger dollar putting downward pressure on its price, all triggered by the same event that, on the surface, should have pushed gold higher. And this is why your gold position might be down even while global tensions are rising. It's not broken. It's not failing. It's following a pattern that has played out again and again over the past 50 years. But here's the part that changes everything. This phase, this pressure, this temporary suppression, it never lasts. Every time this sequence has occurred in the past, it has eventually reversed. And when it does, the move that follows is not small. It's not gradual. It's often explosive. History shows this clearly. After major oil shocks, gold doesn't just recover, it outperforms significantly over time. Not because of chance, but because the same forces that push it down initially eventually flip in its favor. This is where most investors get it wrong. They react to the short-term move without understanding the full cycle. They see red, they assume something has changed, and they exit at exactly the wrong moment. But the reality is, what looks like weakness in gold during a crisis is often just the early stage of a much larger setup forming underneath the surface. And once you understand that, once you truly see the mechanism behind it, you stop reacting emotionally to short-term price moves. You start recognizing patterns. You start thinking in phases instead of moments. And that shift alone can completely change how you approach the next move. Now, this is where the story takes a turn that most people completely miss. Because once you move past the initial drop and look at what has actually happened across history, the pattern becomes almost impossible to ignore. Not as a promise, not as blind optimism, but as a repeated structural outcome that has followed every major oil-driven geopolitical shock for the last 50 years. And if you're willing to look at it clearly, without emotion, without reacting to short-term noise, you begin to see something that most investors never fully grasp. Go back to the 1970s, one of the most defining periods for gold in modern financial history. When OPEC restricted supply and imposed an embargo, oil prices didn't just rise, they exploded. A massive shock to the global system. And initially, gold didn't behave the way people expected. It dipped, hesitated, confused investors. But then, something shifted. Over the next 2 years, gold didn't just recover, it surged by roughly 150%. And if you zoom out even further, looking at the entire decade after the US left the gold standard, gold rose over 20-fold. Not a small move. Not a coincidence. A structural response to a system under pressure. Then came the Iranian Revolution, another major disruption, another collapse in oil supply, another moment where the world felt unstable and uncertain. And again, gold didn't immediately explode higher. It paused. It moved slowly. It tested patience. But within the following year, it climbed close to 90%, followed by additional gains after that. The pattern repeated itself. Delay first, then acceleration. Fast forward to the Gulf War. Iraq invades Kuwait. Oil spikes again. Markets react quickly. Gold moves up, but not dramatically at first. Other sectors, like energy and defense, take the spotlight. But the broader trend still unfolds in the background. Then the post-9/11 environment. Global panic, markets collapsing. Fear everywhere. And what followed wasn't just a short-term reaction, it was a decade-long run in gold, taking it from around $250 per ounce all the way up to nearly $1,900, a move of more than 6 times its value, not driven by headlines, but by deeper structural forces playing out over time. And more recently, when Russia invaded Ukraine, gold broke through major psychological levels again, reaching new highs. The same story, repeating itself in a different era. Every major oil shock, every geopolitical disruption. The same sequence. Initial confusion, short-term pressure, and then sustained outperformance. So the key insight here is simple but powerful. The mechanism that pushes gold down in the early phase, higher yields, stronger dollar, institutional rotation, eventually reverses. And when it does, It doesn't just neutralize the pressure, it creates momentum in the opposite direction. The very forces that once acted as headwinds become tailwinds. But here's where things become even more important. Because what makes the current environment different is not the existence of conflict. We've seen conflict before. What makes this moment unique is the structure of the system underneath it. The foundation that this crisis is sitting on is unlike anything we've seen in previous cycles. Start with debt. In the 1970s, US national debt was measured in billions. Today, it's measured in tens of trillions. That's not just a bigger number, it's an entirely different scale of pressure. The system is far more sensitive now. Interest payments alone are enormous. That limits what policymakers can do in response to shocks. It restricts flexibility in a way that simply didn't exist before. Then look at central banks. Decades ago, they were net sellers of gold. Today, they are aggressive buyers. Not just occasional purchases, but sustained accumulation at levels that have never been seen historically. Hundreds of tons each year, consistently. This isn't random diversification. This is strategic positioning, a shift in how global institutions view monetary stability. Now bring silver into the picture, because this is where things get even more interesting. Unlike gold, silver isn't just a monetary asset. It's deeply tied to industrial demand. And right now, that demand is not slowing down, it's accelerating. Solar energy, electric vehicles, advanced computing systems, defense technology, all of these rely on silver in ways that didn't exist decades ago. At the same time, supply isn't keeping up. For multiple consecutive years, demand has exceeded production. Inventories have been steadily declining. And here's the key issue. Silver production can't just ramp up quickly in response to higher prices. Most silver comes as a byproduct of mining other metals. That means supply is constrained by factors outside the silver market itself. So what you have is a growing imbalance, increasing demand, limited supply, and no quick way to fix it. And that imbalance is building quietly in the background while most investors are focused on short-term price movements. Then there's monetary policy. In the past, central banks had the ability to aggressively raise interest rates to fight inflation, even if it caused short-term pain. That's exactly what happened in the late 1970s. Rates were pushed extremely high to break the inflation cycle, but today, that option is far more limited. With debt levels so high, raising rates too aggressively creates a different kind of risk, a fiscal strain that can become unsustainable. So instead of a system that can absorb shocks and reset itself quickly, we now have a system that carries those pressures forward. Inflation doesn't get crushed as easily. Debt doesn't get reduced. It compounds. And that creates a very different environment for assets like gold and silver. And this is why the current setup is more extreme than anything we've seen before. Not because of one single factor, but because multiple structural forces are aligning at the same time. High debt, strong central bank demand, supply constraints in silver, expanding industrial use, limited policy flexibility. All of these factors are building on top of each other. Meanwhile, prices today don't fully reflect that reality. There's a gap between current levels and where major institutional forecasts suggest these assets could go, not based on hype, but based on long-term analysis of these underlying drivers. And that gap, that difference between perception and structure, is where the real opportunity exists. But to understand how that opportunity unfolds, you need to think in terms of phases, not isolated events. Because this entire process follows a sequence, a progression that moves from panic to stabilization, from uncertainty to accumulation, and eventually into expansion. And where we are in that sequence right now determines everything about what comes next. So now let's bring everything together, because understanding the structure is one thing, but knowing where we are inside that structure is what actually determines how you act. Every major cycle like this doesn't just happen randomly. It moves through clear phases. And if you can identify the phase correctly, you stop reacting emotionally and start acting strategically. The first phase is always the panic phase. This is the moment when everything feels urgent, chaotic, and uncertain. Oil spikes sharply. Headlines dominate every screen. Financial media amplifies fear around the clock. Gold initially jumps as investors rush in, but then, almost immediately, it drops as the mechanical pressures take over. This is where most individual investors make their first mistake. They either chase the initial spike out of fear of missing out, or they panic sell when the drop begins. Both reactions are driven by emotion, not understanding. Meanwhile, institutions, the ones who have seen this pattern unfold multiple times, remain calm. They don't rush. They observe. They position quietly while the noise is at its peak. Then comes the second phase, the absorption phase. This is where things start to feel confusing. The initial panic fades slightly. Markets stabilize, but prices remain weak. Gold pulls back. Silver often drops even harder. Portfolios show losses, and confidence starts to fade. This is where the majority of investors make their most expensive decision. They look at their positions, see red, read negative headlines, and conclude that the thesis has failed, so they sell. Not because the fundamentals have changed, but because the short-term price action has shaken their conviction. And historically, this has almost always been the exact point where selling turns out to be the worst possible move. Because what follows is the third phase, the structural bid phase. This is where the shift begins, quietly at first. The forced selling pressure fades. The large players, central banks, institutions, long-term investors begin accumulating again. Not aggressively, not loudly, but consistently. Gold starts to stabilize, then slowly gains strength. This isn't the emotional buying from the panic phase. This is calculated accumulation based on long-term fundamentals. The same forces we talked about earlier, debt, monetary policy, supply constraints, begin to reassert themselves. Silver, in particular, starts to behave differently here. While gold leads the initial move, silver often lags at first. But once it begins to move, it accelerates much faster. This is because silver has two engines driving it: the monetary demand that gold has, and the industrial demand that continues regardless of market sentiment. As the system adjusts and stabilizes, that second engine becomes more visible. Demand from solar energy, electric vehicles, data infrastructure, defense systems, all of it continues in the background, unaffected by short-term fear. And when investment demand returns on top of that, the move can become significantly more powerful. This is why, historically, silver has often outperformed gold in the later stages of these cycles. Not immediately, but with a delay. And when it does move, it tends to do so with much greater intensity. It expands faster, it rises sharper, and it catches many investors off guard, especially those who exited too early during the previous phase. And then comes the final phase, the phase that most people remember but very few position for correctly, the new highs phase. This is where everything aligns. Inflation pressures remain. Policy constraints become more visible. Interest rates begin to shift. The dollar weakens. And the same forces that once pushed gold down now begin pushing it up, all at once. The headwinds turn into tailwinds. And gold doesn't just recover, it breaks into new territory. History shows this clearly. After every major oil shock, gold has eventually moved into new highs. Not instantly, not without volatility, but consistently over time. The pattern is there for anyone willing to look beyond short-term noise. Now, based on everything we've seen so far, it's important to be realistic about where we are today. The initial panic has already passed. The forced selling, the margin-driven liquidation, that phase appears to be largely behind us. What we are seeing now looks very much like the transition between the second and third phase. The absorption is fading, and the structural accumulation is beginning. Large players are already positioning. Central banks continue to buy. Long-term investors are stepping in quietly. Physical demand remains strong, especially in regions where gold is viewed not just as an investment, but as a form of financial security. And while short-term price movements may still feel uncertain, the underlying structure is shifting. Now let's talk about something that doesn't get enough attention, but could be one of the most important pieces of this entire puzzle, and that is silver's unique role in this cycle. Because silver is not just following gold, it's building its own setup. Unlike gold, which is primarily driven by monetary and financial factors, silver is deeply embedded in the real economy. It is essential in modern technology. Solar panels rely on it as a key conductor. Electric vehicles require significantly more silver than traditional cars. Advanced computing systems, AI infrastructure, communication networks, defense applications, all of these depend on silver in ways that are difficult to replace. At the same time, supply is not responding. Year after year, demand continues to exceed production. Inventories are being drawn down. And because most silver is produced as a byproduct, increasing supply isn't as simple as raising prices. The system doesn't adjust quickly. And then there's the geopolitical layer. Major refining capacity is concentrated in specific regions, and restrictions on exports can further tighten supply. So what you end up with is a market that is already under pressure from a supply-demand imbalance before investment demand even fully returns. When that investment demand comes back, which historically happens in the third phase, it doesn't replace industrial demand, it stacks on top of it. And that combination is what creates the kind of moves that have defined previous cycles. So the real question now becomes, how do you know when the shift is fully underway? Not based on headlines, not based on daily price swings, but based on actual indicators that reflect the underlying mechanism. There are two key signals that matter more than anything else. The first is the strength of the US dollar. During the initial shock, demand for dollar-based assets pushes the dollar higher. But as the system stabilizes and pressure eases, that strength begins to fade. When the dollar starts to weaken meaningfully, it removes one of the biggest pressures on gold. The second is interest rates, specifically long-term yields. When yields are high, gold faces competition from income-generating assets. But when yields begin to decline, that competition weakens. And that shift often signals that policy is starting to adjust in response to broader economic pressures. These two indicators, the dollar and yields, tell you far more about the direction of gold than any headline ever will. They reflect the actual mechanics behind the market, not the narrative built around it. And here's the reality. Major institutions, the ones managing the largest pools of capital in the world, are already making projections based on these dynamics. Their expectations for gold prices over the coming years are significantly higher than where we are today, not because of speculation, but because of structural analysis. So at this point, there are really two types of investors. The first type sees recent price declines and assumes the opportunity is gone. They exit. They move on. And later, when prices recover and move higher, they look back and realize what they missed. The second type sees the same situation differently. They recognize the phase. They understand the mechanism. They see the structural setup that is forming beneath the surface. And instead of reacting to short-term noise, they position themselves quietly, patiently, while the market is still uncertain. Over time, it's always been the second group that benefits the most. Not because they predict perfectly, but because they understand the process and stay aligned with it. And this is why the move ahead is often described as something that feels almost unimaginable, not because it has never happened before, but because very few people are positioned for it when it begins. The conditions today, higher debt, stronger structural demand, tighter supply, limited policy flexibility, are more extreme than in previous cycles, which means the potential outcome could be larger as well. So instead of focusing on daily fluctuations, focus on the structure, watch the key indicators, stay patient, and most importantly, don't let a temporary phase convince you that a long-term setup has disappeared. Because if history is any guide, what comes next is not just a recovery, it's a shift.